Well, as we've explained for some time, there comes a point, probably next year, when consumers' wallets dry up in the face of rising interest rates, energy prices and overall inflation. If that happens, well, when that happens, secondary questions will emerge undoubtedly about the strength of companies to deal with any downturn. Moody's Investor Services has already cast its mind forward, and especially around the real estate industry. Saranga Ranasinghe is the Vice President of Moody's Investor Services and joins us now. Saranga, many thanks for your time. You've looked in particular at the real estate market, looked at the way in which people cope with the housing industry and just how those big companies in that sector are going to manage. But broadly, you're saying they're not in bad shape, even if there is a decent downturn.
Yeah, that's right. We actually rate three of the largest developers in Australia. So that's Stockland, Mirvac and Lendlease. So if you look at those three companies, their exposure to the residential development market for Stockland is actually the highest, anywhere between 30 to 40% of earnings. For Mirvac, it's about 20 to 30%. For Lendlease, it's still in the single digits. So they are diversified when it comes to their end revenue exposure. So that diversification sort of cushions them from a reduction in housing volumes or demand for residential sector. So that helps them. And also the fact that they are very well positioned when it comes to their financial policies and financial metrics as well, because from a credit perspective, what we are looking for is that headroom when it comes to our rating as well. So both, I would say all three companies are very well positioned to deal with a downturn because we know the downturn is coming. Right now, they have very high visibility when it comes to FY23 or the financial year ending in June 2023, because they are sitting on quite a few of pre-sales that they've already done. But the concern becomes FY24 because of sales that they would have to be making right now. But those sales are actually being impacted because of all those conditions that you mentioned. So our focus becomes what will they look like in FY24. So which is think, given their revenue diversification, sorry, go ahead.
Yeah, I was going to say, which is exactly what you've got to do. So tell me broadly, what are your presumptions when you try to stress test these businesses and you try to assess what shape they will be in 12 or 18 months' time? What are the presumptions you make about the housing industry, about interest rates, about the broad metrics that are going to be there at that time?
Yeah, so, I mean, as you rightly pointed out, its inflation is pretty high. So it's way above the 2 to 3% target range set by the RBA. We've seen interest rates go up to 175 basis points. But given where inflation is right now, we are expecting further increases when it comes to interest rates as well. So there is definitely going to be a pullback. So that's basically our expectation, that pullback in demand for residential real estate. But that for us becomes a short-term view as well, because we think in the long run, Australia's residential segment is very well positioned because we have pretty strong population growth compared to the rest of the developed market. We have, and this is being supported by net migration as well. And then despite being country, we tend to be land constrained in areas where people want to live. So given all of these factors, our longer term view is that there will be a recovery in residential market. But in the next, I would say in FY24, FY25, our assumptions that we're using is that there is going to be a pullback. It's going to be definitely below what we've been seeing for the last 12 months. But at the same time, we have to factor in the defaults that we should be expecting when it comes to the pre-sales that these companies have made. So in this environment where unemployment rates are still very, very strong, the expectation is that we are not going to see the same default rates that we saw in previous cycles, given where unemployment levels are, and that these default rates would mean that the pre-sales they make would pretty much be realized when they need to deliver that product. So all in all, I think our basic assumption is that there will be a slowdown, but it's not going to be as material as it has been in previous cycles.